Hello there, Nick from Nick's Investment Lab, and today let's talk a little bit about the different types of investments. Firstly, the good old GIC. This stands for Guaranteed Investment Certificate, and most of the big banks, pretty much all banks, are going to have some form of this available. Now, the reason that it has been appealing for investors historically is that special word at the beginning, guaranteed. Now, nothing in life is guaranteed except death and taxes, but the guaranteed portion is coming from the fact that you will not see any volatility within this product. You buy into it, they're going to guarantee you an interest rate, and at the end of the period, you're going to get the amount that you invested plus this promised interest rate. With that being said, there are a few different conditions that can differ between GICs. Firstly, cashable GICs will have a given interest rate, but if it's redeemed, let's say within the first 90 days, you might not receive any interest, or 90 days to the first 120 days, maybe it's a reduced interest rate. So they do make it accessible, but if withdrawn early, the amount that you actually earn is reduced. Generally, more typically, you're going to be encountering the non-redeemable GICs, which is where you enter into the locking in your funds for an elapsed period of time, whether it be 1 year, 12 months, or 1 year, 18 months, 24 months, etc. And at the end of the period, earning your principal amount back, as well as whatever accumulated interest has accrued over that time period. Full disclosure, GICs are probably my least favorite investment type because I feel that there's a lot left on the table. I do think that they have their place, especially when you need a fixed amount of money, certain, and not flexible with any sort of volatility along the way. An example of this could be needing a down payment for a house in exactly 12 months, or maybe funding a child's education the following calendar year. Another common type of investment vehicle is the stock. Many people, I feel, are familiar with what a stock is, but just in case, a stock is a small ownership share in a publicly traded company. So you could go and buy one share of Apple, and then you would be a very small owner, but an owner in Apple. This allows you to participate in any upwards growth as well as downward retraction as well. This has been evident in some companies, such as BlackBerry, where we saw them fall from about $80 a share down to 10 or so and never saw a full recovery. So it isn't without any risk. With that being said, I think that there's a different level of risk associated with different types of stocks. So the three main types of stocks you're going to see are large cap, mid or medium cap, and small cap. Now, I feel that large cap is probably going to get the most love because it's often seen as the safer, the dividend paying. These are the bigger names you're often going to encounter. Generally because they're larger companies, and the larger the company, generally the less chance that it has of failing. But of course, nothing is without its risks. The main benefit of stock, unlimited upside potential. The main downside is that you could lose the entire amount that you had invested. And if a company does go bankrupt, the chances are that you're going to be one of the last people to get paid. So you very well could lose your entire investment. Another more common type of investment is the bond. Now, what a bond is rather than owning the company, you own a company or a government's debt. So think of it as being like a debt holder. So if you have a mortgage, the bank is the one that owns your debt. In this case, you're almost like owning a mortgage for the company or for the government. They're going to be paying you a fixed interest rate over a fixed period of time. And the main difference here, opposed to like a GIC, for example, is that you can sell your bond on the open market. The main difference, however, is that this value can go up and down, generally depending on interest rates, but can also be linked specifically to the company's performance. You can still technically lose all of your money in a bond if a company is to go bankrupt, but bonds are generally considered safer than stocks because if a company does go bankrupt, this company is going to have to pay the people that it owes money to first before any of the shareholders get any money. So generally speaking, if a company did go bankrupt, you're likely to recoup some of your loss. With that also being said, a lot less upside potential yes, you can sell a bond for a gain, specifically if we see interest rates decline from when you bought the bond. But generally speaking, unlike a stock, you don't have that unlimited upside potential. And though technically you can lose your full investment, the likelihood is a lot lower than with a stock. Lastly, for the sake of today, we have our managed products. I'm going to call this ETFs, mutual funds, and liquid alternatives. Now, what do these entail? And how do they differ? So when I say a managed product, I like to view this as your pre-made portfolio, or once again, managed or being taken care of by somebody else. So an ETF is going to trade a lot like a stock. You can buy it on the open market. It's going to go up and down in value throughout any given day. A mutual fund, on the other hand, is not going to fluctuate throughout the day, but is a basket of a variety of different products, whether it be one specific type of stock, a mixture of stocks and bonds, or even 100% bonds. It isn't necessarily limited to what it's made up of, but more so how it's structured. Lastly, the liquid alternative is going to be escaping the traditional structure of most mutual funds, for example, are going to be primarily composed of stocks and bonds. Long stocks and bonds, meaning that you're not short selling as well. Getting into liquid alternatives is where you start to see the use of derivatives, so options such as calls and puts, as well as the use of short selling. So this is an up-and-coming type of product. It's something I use a lot myself, but not necessarily as commonly used. I think the most important thing to note about ETFs, mutual funds, and liquid alternatives opposed to stocks and bonds is that if you own one individual stock and one mutual fund, 9 times out of 10, I'm going to say you're a lot better diversified in your one mutual fund or your one ETF, because you own a variety of different companies or a variety of different products within this managed product. With that being said, one mutual fund and the next are not necessarily equal, and probably are not equal. For example, you can buy some mutual funds that are very conservative, and by definition, generally we mean about an 80% to 75% bond and a 20 to 25% stock ratio. So something like that, once again, we talked, bonds are a lot less volatile, a lot more consistent. Theoretically, you should see a lot less risk in that, or a lot less volatility. With that being said, some mutual funds are 100% stocks, and further than that, 100% in one particular sector. So you could have a crypto and AI fund, a lot of ones that I like to use myself once again, but generally these are going to be a lot more volatile. So those structured similarly, the holdings within them are very different, meaning that they're going to act very differently. Like every other video, the best advice I can give is to consult with a professional. Please feel free to reach out, nixinvestmentlab@gmail.com. Happy to give any insights that I can speak to. And please give us a like, comment on maybe your favorite type of investment product, and subscribe to our channel, Nix Investment Lab. Thank you for your time, and have a wonderful day.